Welcome to the Airmere Training Group 1 meeting. Today's the 15th of March. So if you have a small business, this is when your taxes are due, I think, and any deposits to your self-employed IRAs and stuff. So just a reminder, this is the last day for that, if that applies to you. I just closed out a boxcar trade. They opened Thursday. I can walk you through that. But before I do, I don't want to forget this. I just got off the phone with Brian Vogelman at Option View or Capital Allocation, and he said they just got an email today from their data providers that the Tuesday expirations on SPX are going to go live on April 18th, and the Thursday expirations on May 11th, pending regulatory approval, but that's their plan. So it's coming pretty soon. I know there's definitely some interest in like zero DTE or extremely short trades. I know kind of the community here is kind of migrated. Tom, you and I were talking about the road trip trade. Those were like 90 DTE trades, so pretty far out. And the idea was that you just put it on, let it sit and bake. But as time goes on, the markets are volatile. People seem to gravitate more towards the shorter term trades, like Amy's A14. I think she puts it on with 2 weeks expiration, but she's out as soon as she has like a 5% profit. So I don't think that usually takes 2 weeks. It's much shorter than that. And Steve Gantz also is a lot of shorter term stuff. I don't know if Steve's here yet. I don't know if he's coming today. But he has a combination of short and longer term stuff. I guess he'll go into that in his class, but he's also going to give us an update. I think it's next week of how his butterflies are doing and just answer some questions and stuff. And then the boxcar, of course, with Dan Harvey. That's 8 or 9 days expiration. And like I put one on Thursday and took it off today. And I could have left it on earlier or longer, but we got the FOMC thing tomorrow. And, even though I've got plenty of room, I just felt more comfortable just taking it off. And I made like 3.25% or something in a couple trade, like 5 trading days or 5 days, calendar days. And I'll go through that. But that's good news with the zero DTE possibilities for Tuesday and Thursday. I had dinner with a friend in Belgium when I was there, and he runs a fund with a couple $100 million as a Morgan Stanley trader, and he loves the zero DTE stuff. And instead of a futures contract, he'll do an option spread, and it's a defined risk, and it expires the same day, so it's a high octane trade. So anyway, let me share my screen here. And I found a weird thing with option view too. I was clicking on this analyze button, and this is the analyze chart, and it was like it 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 just blinked. I didn't see it anywhere. And apparently what happened is I had option view on a different screen, and the option view workspace thinks or remembered that that analyze screen was or this dialog box was on a separate window. So when I clicked on it, and even though I had it on this screen, it was trying to open it on the screen to the right. So when I had the like full screen option view across all my monitors, and then I saw it, and then I could move it, but that was kind of weird. But anyway, this was the boxcar that I put on Thursday. I've got a copy of the transaction log, and it's kind of fun to use option view again. I like OptionNet Explorer, but I've been using option view since like 2006. So I don't know. I'm a dinosaur, I guess, but I really like option view. So it's um it's like riding a bicycle for me. So anyway, this was the initial boxcar trade, and I have a spreadsheet that I got from Dan. I've kind of been modifying it, and we're monitoring some risk metrics. But basically, what you're trying to do when you're entering these trades, actually, I can probably bring up the spreadsheet that I've got. I'm building. So this is to kind of help find the strikes that you're gonna use. So let's say we're gonna put on one that expires next week. So normally I would put it on Thursday for a Friday expiration. So maybe I can try the 23rd because that's the same number of days expiration. Let's see if we can get some data for this. Okay, so that's 8 DTE. And now the volatility, we'll use Thinkorswim. And for the 23rd, let me go across to the right one. Let me just expand it, then I won't miss it. 31.57% is what we're looking at. So we'll go 31.57%. And so we're looking for maybe at least 1.3 standard deviations, maybe 1.4. But this is going to highlight on here. These are all the current prices, and you can change the spread width. But if you're doing 20Y like on the Russell or 25 on the SPX, that's how much these spreads are costing right now. What the spread potential profit is, the delta, the theta, and it depends on how many contracts you're trading. Say we're going to do a 5 lot. It'll tell you how much credit you get. So we're looking for, these are all conditional formatting. So these are the strikes that are within 1.3 to 1.4 standard deviations. And it generally ends up that these are around 10 or 11 delta. So, any of these are probably fine, but this is kind of the sweet spot. So then we'd be looking for about $2 credit for this, say a 39.80 25 wide put spread. And then you put that on, and then after you've got that, well, you look at the credit you get. Now the total credit, say we're doing this 5 lot, and we pick this one, we're going to get about $10 for the credit. Now Dan will use 1.1 to 1.2 multiplier for that, so 11 or $12. That would be the maximum that he spends on the debit spread. Now, you can spend less, but that's the maximum. And then you're going to put the debit spread on, so your total position delta is roughly 1+1 for every credit spread you've got. So if you got a 5 lot, you want about a 5 delta to start with maximum, or about that range. And then you can adjust these strikes up and down to get the delta that you want. And then that creates this initial position. And option view has kind of a cool thing, this expected return. Now, interestingly, it's just using a bell curve, and it's just looking at, like, I think 20 slices or maybe more. And it's adding them all up and figuring out what the expected return is. And it starts out just slightly negative, but the way we manage it, it ends up making money. I think Dan's SPX trades are a little over 80% wins. So then the next adjustment I did was about an hour later. And that's one thing. Option view is, again, it's older. It's 15-minute increments, and I think Brian's going to be updating. They're writing a new version, and I'm pretty sure they're going to have more granular stuff like O&E, where it's like 5 minutes or maybe less. So at this point, the market has moved down, and let's see if I can do these R codes or not. A, B, C. Oh yeah. So this is what I did. I'm starting to harvest some of this stuff. So we sold this strike for $61. It's trading for 54. And now if we roll it up, we're actually going to do that for a credit. So that's what, about a $3 credit roughly. So you would basically take that $3 and put it in your account. It's going to lift this expiration line up. And that's the whole idea of harvesting. Scott Rubel uses this a lot with Rolling Thunder. They'll put on a put spread, and then the market moves down, and then the put spreads are making money. He'll start selling out some of those put spreads or adjusting them like this. So here I just rolled up a strike, and that's turning an unrealized gain into a realized gain. So the nice thing with that is that the market reverses and starts heading up, this whole spread's going to start losing value, but you've pulled some money out of the trade already. So that's, I don't know if I go another 15 minutes, it should show, no, it doesn't yet, maybe on the next day, but there's a slight realized gain with that. Let's see, got a couple questions. Oh, and Wayne says to all the VXX traders, Barclays has stopped new issues of VXX indefinitely. Interesting, Wayne. Okay, so here's this boxcar. The next adjustment I had was, where is it? The next morning, actually, after the open. Now I'm on Mountain Time, so the market opens at 7:30. And what did we do? Oh, yeah, market moved higher, and I think I rolled this up a little bit again to try and get a little bit of cash out of the trade. And now the expiration line's at 457. It started a lot lower. You can see our expected return has gone up quite a bit already. Now it's plus or minus 1370, but um, here's two standard deviations at expiration. If you mouse over it, it's 24.6% vol, and this is like slightly more than two standard deviations to your short, so it's pretty safe at this point. And here's still the original spread. But the market did kind of bounce around a lot. So we've got, where's this thing? This is where I entered the market or the trade. And then this is the Friday we're looking at. Market ran up and then closed down. It was over 100-point range that day. So it wasn't looking too great. But on the way down, I was starting to harvest some more stuff. And there's some more of the debit spreads. And the next adjustment was about noon. 11:45 actually. And here I rolled the debit spread up even tighter, and now our let's see. So this is at 457. Does that include the adjustment? Actually, there's quite a few adjustments here. The 11th. Okay, so we've got this really narrow debit spread. And like Dan Harvey said, if the market's moving really up strongly, you can take the debit spread off intraday, but he always has one on by the end of the day. So if you're in an uptrending day and you don't want to have this put debit spread on, just take it off, but make sure you put it back on by the end of the day. And now, how come on these are codes? Oh, I'm gonna have to redo this. Oh, yeah, there it is. I don't know why it wasn't updating that. So anyway, the market was heading down and the delta was getting a little bit higher. So I wanted to put a couple of puts in front of the credit spread, and that reduced the delta down a bit. So if I take off, let's see this, oops, and this, and then I gotta hit analyze again. Okay, so that's what it was. The market was moving down. Delta, what did I adjust here? At the time, I remember the delta was like 6 to 7, and I wanted to basically flatten this out a little bit more. It actually did move down to here. It's hard to get granular with this thing because the adjustment was around this time. Let's see what it pops up with the price. 55. Oh, I gotta probably do this. Basically, maybe do the side by side. Should keep it updated. Yep. So that basically flattened the position down and took some of the risk off. So the margin on this before I added these two long puts was something around 11,000, roughly 11, 12,000. But by adding these puts, it cut the margin required down. And I did that because the market had been heading lower. And this was actually fairly close to some daily support. And I was concerned that if we kind of kept going down here, it could go pretty far. So I wanted to add a little bit of risk reduction in there. And then with the debit spreads, after the market sold off, I kept rolling these up and bringing in more credit. So the expiration P&L is here at 490, and but this is easier for me to live with less risk. Just essentially trying to start taking some of the profits out of the trade. And then next was Oh, I guess that was the last adjustment on Friday. So the market closed, I think it was below these spreads. Yeah, so that's where it closed. And then today, and I'll just do half an hour after the open. The market's rallied up a little bit, but I was worried about the FOMC meeting because we know they're going to raise rates, but you don't know what they're going to say and how the market's going to react to it, plus all the stuff with Russia. So this morning it was up a little bit. It was kind of close to break even. I think vol must have gone up. And then the market was rallying. This is up 11. And then as time went on, here's another 15 minutes. Now we're up 30 instead of up 11. And we're starting to get some nice profits. So we're up here at 348. I was like, well, 348 on 11,000 a margin is a nice return in a couple trading days. So I just decided to close the whole thing. So by 8:30, it was flat, and that should be flat. Oh wait, that's the wrong day. Yeah, so it's flat today, and then here's the final result. So it made $406. That includes commissions and 5 trading days on like what was the max margin, like 10,800 or 11,000. So it was up like 3.25% in 5 days. So kind of typical performance for the road trip. Dan's been getting 2 to 5% a week. And I'll go over all this with all the rules and risk metrics that Dan's looking at on Thursday's roundtable. But that's kind of how things went down with this this boxcar trade, and worked pretty well. Even with the market volatility, these short-term trades are nice. It's probably not suitable if you have a job and you can't check the market a couple times a day. Dan's feeling is that you can watch it, after the open and before the close. And you probably want to have some kind of alerting system if the market's making some big move, like say after the FOMC announcement. But anyway, that's kind of how that boxcar trade worked out. And Wayne, so it looks like he has some more information about the VXX. Hey, Wayne, are you at your computer? I think you're muted. I can see your microphone.
Can you hear me now?
I can.
I had it set to the wrong microphone. That's what happens when you have like 7 of these things, right?
That'll do it, right?
How's it going today?
Pretty good. Like I said, I just closed this boxcar for like a 3.25% return this week, so that was good.
Nice. Yeah, it's a very good environment for these things.
Yeah, I mean, let's see, what's the volatility at? Go pull up a trading view. Let's see. So here's the market. This is a daily chart. So we have a nice rally. And interestingly, Adam Grimes was talking about this the other day. He said, my annotate tool. When this was coming down, this looked like a nice bear flag setting up, and it did go down some, but that's kind of stopped going down. So it's kind of in a box or congestion area right now. So he's thinking it's going to probably stay here for a little bit. But we'll see what happens with the FOMC tomorrow at 2 o'clock Eastern.
Yeah, it is a little bit harder and harder for the market to kind of keep pushing down. I mean, it is a thing that, I mean, I think a lot of people know my stance on it. At least it definitely if you're a subscriber, but bounces are a real thing in bear markets. So
Well, typically the biggest updates happen in bear markets, right?
that is very true. And it's just because the volatility is so high. Like, I mean, it's like, so it can really fake you out. And I mean, that's why risk kind of increases in bear markets too.
And this is an interesting thing to look at on a weekly chart. That's a bull flag.
Okay. If you don't want to, yeah, you can look at it like that.
Now,
You could
Adam
say
said,
COVID was a bull flag too, I guess, right?
well, Adam said, there is a school of thought that this is a great buying opportunity, but he thinks that the bias is kind of heading lower. So he said, if you're going to trade like that, you have to realize it's very risky, and be prepared to have stops in place because they may be right, but this could be the start of something moving down pretty significantly.
This, I mean, just to kind of like throw this out there, right? And I'm writing an article on this today for the subscribers, but just to kind of bring this into perspective, this is going to be the fastest tightening sequence that we've ever seen from the Federal Reserve. They've stopped issuing all of their, they've stopped buying new assets, so they're effectively halting all of that. So they're going to maintain their balance sheet. They're tightening rates this month, and then I mean they might even do a couple. They might even do like a 2 interest rate hike, like would be like 50 basis points. And then they're even talking about actually actively tightening, which is selling assets at the same time. If they do that, if they do accomplish all of that, and they did it in a span of 2 months, basically since December, it will be the fastest turnaround in history for monetary policy. And just to kind of give you an idea, when they stopped buying new assets, there was one in 2010, which was flash crash. 2011 was another one. And then also in 2018 was when they started to actively tighten monetary policy, which was in that February, right? And every time that they do that, every time monetary policy shifts that aggressive, it does create, volatility in the markets. And basically, since they've stopped buying new assets, we've seen the market correct. So if they continue to go and they push even further and they raise interest rates and start actively selling at the same time, you're going to see all of that magnitude happen all at the same time. So that's the kind of risk to the downside.
Oh, and that weekly chart, I was noticing the ease of movement indicator that we talked about
Oh yeah.
before. It's not positive, is it?
No, it's definitely not on a weekly basis. Yeah, it's 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 definitely easier for this thing to slide to the south. And I mean, even on a daily time frame, it's a little bit easier to fall to the south. It's just for the volume. I mean, the price is just being pushed down pretty aggressively. That doesn't mean that it's necessarily there. Although, have you seen consumer sentiment recently?
Have
Like
not.
consumer confidence? Oh man, now this is
Is that something you
um,
can show us?
yeah, I can pull it up really quick. I think I've got it bookmarked. I'm pretty sure I do. Yep, there it is. Let me. All right. Let's see here. I had it bookmarked at OECD, but let me pull it up on a different one. Because this one will actually, because it comes out of the Michigan. Let's see. Consumer sentiment and consumer confidence is 2 different things. So let me pull this up. So I'll pull it from the Fred. Here we go. I'll share screen. All right. So this is consumer confidence, just to kind of like zone this in. University of Michigan kind of issues this, and this is from the Federal Reserve. They collect this data also. So you can kind of see here that basically what this does, just to kind of give you like a brief overview, is the University of Michigan talks to a survey of people across the United States, and they say, hey, how are your financial conditions and how do you expect those financial conditions in the future? And are you willing to make large purchases right now? Right. And basically the further south this goes, the less people are, the less the general population is willing to make large purchases, is saying that their financial condition is getting better or anything like that. And the higher it is, the more people feel everything is great, right? So you can see here prior to COVID, 2017, 2019, everyone was pretty happy actually. Relatively in the highs around 100 historically, right? And then COVID happened and we dropped down really low. We started to bounce a little bit back, but actually, since about May of last year, April, May of last year, it's been dropping very steadily. And right now, we are very low in our consumer sentiment. What does that mean? I mean, it could be considered somewhat of a contrarian indicator if you wanted to look at it like that. So if you wanted to look at it as a contrarian indicator, that means February of 08 would have been a great time to buy. Of course, then you, of course, get nailed in the October crash and the further push down in 2009. So you kind of got to watch out with being contrarian sometimes. But by the time 2011 came around and the consumer sentiment dropped off, that was because we had the debt crisis in 2011. The market had been pushing up, things have been looking better and everything like that. So that would have been a nice contrarian push. But basically, you can see here going into these big bear markets that things aren't exactly fun. So we are getting this kind of second push down. It could be a second push down like what we had in 1992, things like that. So just in general, though, inflation getting higher, fixed costs getting more expensive, right, with oil and things like that. And then the general consumer not willing to buy as much. And then, companies cutting off customers in Russia. I mean, it's kind of all spelling out that there's going to be a contraction in profits for companies, right? So that's kind of where things are at right now. But yet again, stocks still bounce, right? So
They do, don't they?
they do. They don't go straight down. Bear markets do not go straight down, right? It's not like COVID. COVID was like a freakish thing. That was a pandemic that's not going to happen most likely again. But I believe if we pull up like emerging markets, which I can pull that up really quick. EM or emerging markets. I could show this in TOS, but I've got a lot of stuff on my screen. So let me just pull it up in Yahoo Finance. Hold on. So I've talked about emerging markets quite a few times. And just to kind of reemphasize what's going on in emerging markets, just so that everyone is familiar. Let me share screen again. So here's emerging markets back here, and this is like a long term. I mean, this is all the way back to like 2003 and stuff like that. But basically, since early last year, right, we started to, in the sleep well portfolio, we started to talk about a rising dollar situation last year, and we basically had that ever since, and that's a really bad thing for emerging markets. So you can see that that's actually been an issue, but emerging markets are now below their pre-COVID levels, right? So emerging markets are down pretty aggressive. The US has been able to stay upright and everything like that. But basically what's happening here is as there's a dollar demand in a strengthening dollar environment where other currencies are weakening, there's like a cash grab for dollars, and emerging markets are having a harder time getting a hold of dollars. And so it starts to create capital flow issues for emerging markets, and they start to really have some issues. So anyway, so that, and then I kind of noticed, or I kind of shot out on here on the chat that the VXX is, I put a link to this article that the VXX is suspending their new issuance of their inventory for their ETF for VXX and oil. So something, if you're like a short VXX seller or something like that, just know that they're not issuing anymore right now. So there's kind of like the same concept with dollars. There's less of them out there, so they're gonna be selling for premium, or vice versa. They could be selling at a discount if there's heavy volume on the opposite side that day. So inevitably they might reissue back out, and then it'll crash back down. This happened to, if you guys remember, TVIX. I don't know. Did you ever trade TVIX, Tom?
I never did.
So TVIX was like it was basically a 2x VXX, right? It's kind of like UVXY is, right? But anyways, TVIX ended up soft closing. They basically had this issue where they stopped issuing a few times, right? Because it costs the bank money if there's extra risk, so what they have to do is they have to buy futures to offset people's selling or buying of the ETF. And so basically, if it gets too far out of whack where it's really hard to hold that risk because of the volatility in the underlying, or they see that the volatility is about to explode in the underlying or something like that, they can basically say, hey, we're just going to stop issuing new ones so that they stop taking on that extra risk. But then it makes the underlying kind of explode there for a little while. And what happened in TVIX was, as soon as that bank started to reissue new shares, it just basically like almost crashed TVIX right back down to where it should have been. And then they would have later on, they would eventually do it again, and then it would explode, and then they would, yeah. So it was over and over again, and eventually they just stopped. They just said, hey, look, we just can't keep up on it anymore.
I think in that
'Cause
article it said they're just basically not comfortable with the risk.
yeah, they're saying that it's not part of market dynamics or anything like that. But I mean, VXX was alive through COVID. It was alive through the 2018 Volmageddon and stuff like that. So I'm wondering if those two events basically caused them a decent amount of capital, if they had some issues maintaining risk and they took some undue losses. And I bet you what they would do is they just say, hey, we're just going to suspend it until maybe this Fed announcement goes out, just in case it turns into a catastrophe. And then as soon as it's over, they'll be like, all right, we're fine, we're back to normal or something like that. So we'll see what they do. But it's an interesting dilemma. So anyway, so if anyone's like a short seller and they're expecting VXX, so I occasionally will short VXX, or I'll buy puts on VXX, and it offsets some delta risks in the larger indexes. But anyways, so just FYI, it's not going to follow what you typically think of, right? It's not going to follow contango or backwardation or anything like that. UVXY would be an alternative. UVXY is still available, but just remember that it's 1.5x. So anyways, just an alternative to help out people.
Nice.
Yeah.
And I see the
So,
sleep well still cranking along.
yeah, it's doing its thing. Gold and dollar, it's a really volatile market right now. So ups and downs are part of the deal. And what's really great in volatile markets is historically the sleep well has its highest performing years when the VIX is above 20. So always a good thing. So
Check out
it's
this oil
volatile.
chart.
Yeah, that's came back to earth.
That-
And I mean, that was kind of one of those things that, we did a squeeze on Russia, right? And then we go to Saudi, and we go to, and also the US starts to unleash a bunch of barrels too. But that's a short-term solution. That's not a long-term solution, right? And then on top of that, it is denominated in dollars. So as the dollar strengthens, that'll also weaken
Here's your dollar
crude.
chart.
Yeah, the dollar's a beast right now, and it is projected to continue to do this for the next 2 quarters, by the way. Not like straight up. I mean, I'm not talking like a hockey stick in the dollar, but it is meant to trend higher.
Well, and speaking of strength in the dollar, that makes all these currencies denominated in dollars go down, like the euro. I remember when we bought our house years ago, it was at 126, and the most I paid for a mortgage rate on the conversion was 157, and here we are under 110.
Wow.
So now's a good time if you're an American getting paid in dollars to live in Europe or go on vacation there.
Right, right, right. Yeah, good conversion rates. And I mean, yeah, you're gonna I've got a friend looking to buy property down in Brazil. And I told him I was like, just wait till later this year. The dollar is gonna be even stronger. And he's like, all right. So it's funny.
Let's see, what was I gonna show? Um, well, here's the gold chart, which is kind of
Mhm.
following the oil chart, really.
Yep. Commodity disinflation. Yeah. And this is a whole thing that I don't know if it's always perfectly explained well, but gold likes to follow real interest rates. And for anyone that doesn't know what real interest rates is, it's basically what is the inflation rate subtracted from the interest rate that that bonds are covering. So basically, if bond yields are going up, right? If bond yields are going up, but inflation isn't going up anymore, then the real interest rate is actually being squeezed, right? So right now, real interest rates are negative because inflation is significantly higher than interest rates. But as the Federal Reserve raises interest rates and inflation slows down at the same time, you're going to get a squeeze on real interest rates, and that's technically a bearish thing for gold. So just something to keep in mind.
Nice. All right. Well, thanks for the update, Wayne.
For sure.
Yeah. I saw Steve was here too. I mean, are you still here, Steve? Doesn't look like it. He was here earlier, but I guess he's not here. Steve's been he's gonna have that butterfly class. I think it starts on the 27th, and then we've got a roundtable scheduled for next week. He's gonna go over how he's been doing as far as performance wise. Let's say in the last month or two or three. But it looks like he had to step out. So, um, what else can we talk about? Any ideas, Wayne?
Oh, there's always lots of good ideas. So, um, one thing is let's see. So we've got the ES, we've got the NASDAQ, and we've got the Russell. If you pull over the Russell really quick, you can see that we've had a nice trending sideways right here.
Yeah, and Adam was
So
kind of talking about this too. We had my annotation thing going here. I don't know if I can do a straight line.
hey, that was
Kind,
pretty good for with a
kind of,
mouse.
kind of straight. Yeah. So it was in this kind of trading range for most of the year, really, almost the whole year. And now we're kind of consolidating in this kind of range lower, which he said is probably not bullish. So he was he was looking at a bunch of markets in the China market. I forget what symbol he was. He was using the trade station for that. That was
I
really
think I think
really
it's
terrible.
CHI. I think CHI is it CHI? I think that's the ETF that follows China. It's MSCI is China's. Let
Let
me
me do a
see if
search
that's
here.
right.
Maybe I can find it.
MSCI runs it.
Maybe this one.
MCHI, it might be MCHI.
Let's
Yep,
take a
it's
look.
MCHI.
Yeah, check this out.
MCHI.
It's just getting obliterated.
Yet again, stronger dollar, bad thing for emerging markets.
You look do a weekly chart. In fact, it hasn't been this low since 2017. And maybe just the monthly chart here. Let's see, 1 month. So the all-time low is around 30 something. It's at 40 out of 96. So it's definitely in trouble.
Yeah, yeah, China's not doing very hot right now, that's for sure.
But he was looking at some European indexes, and kind of the general feeling is that more bearish than bullish. So that's probably for us kind of you know uh, the odds of it recovering, like doing a V bottom, are kind of over. I think if it was going to do a V bottom, it probably would have done it here and just kept going, but it didn't. So now we're kind of in this sliding down thing.
I mean, it is one thing that to note that, I mean, just to kind of talk about another aspect of what happens in markets is there are capital flows that will affect, relativity, right? So, China's looking very nasty right now. Emerging markets are looking very nasty. The dollar strengthening, right? Which, as the dollar strengthens, that means American assets that are denominated in dollars can later on be converted at a very good rate to other countries, right? So that does create like a vacuum, or like a black hole of capital just being sucked into the United States, right? So it can actually support markets a decent amount just from that net effect, until it reverses course, right? As soon as the dollar starts to weaken again, or risk off becomes a certain point, or such as bonds get to a certain yield level. As bonds get to a certain yield level, then the attractiveness to American equities starts to be outweighed by the yield. And yeah, if you look at the yield,
Here's the
so
10-year.
my models had actually said that we had pretty much bottomed out back. Um, we looked like we had bottomed out a few weeks ago, and yeah, not so much. Now we're pricing in over 7 rate hikes
I
this
heard
year.
that.
7 rate hikes this year. That's insane. Like,
I
if
mean, you're
they can
lucky to
tap
get 1 or 2, but 7.
7 rate hikes. I mean, like I said, this will be if they actually do this, and for how much the bond market is pricing in, if they can pull off 7 rate hikes this year, it'll just the neck snapping whipsaw that we're going to see in risk assets, like what we saw. I mean, it'll trump anything that we've seen in 2011, when we attempted to stop the buying of assets in 2011, or Volmageddon 2018. I mean, yeah, it's just amazing. If they can get off 7 rate hikes this year without completely crashing asset markets, and they've already basically done it, right? I mean, um, I wrote about something. Have you ever heard of something called the shadow rate hike, or the shadow rate?
Well, I used to look at John Williams at Shadow Stats. Is that from that?
Slightly different than that. Let's see. Because that's an individual, and I'm grabbing here. Let me see here. I can grab this
By the way,
link
this is
since
the consensus for tomorrow's announcement.
Oh yeah, what is it? What's the consensus?
0 to 0.25%. Wait,
Um,
that was the actually that was January 26th. Let me see if I can
yeah,
find
I
it.
mean, because I think the consensus now is that they're at
It's gonna be
least going to go at a
different.
50 basis point hike this time around.
Yeah, let me see if I can find it. Sorry.
So I sent you, I threw a little bit of link in the chat right here. And anyone that wants to take a look at that, that is what's called the shadow federal funds rate. I wrote about this in the weekly article last week. And anyways, just to kind of give a brief overview, what happens with the shadow federal funds rate is it's basically what is the Federal Reserve's total, with like what their interest rate target is, plus what their quantitative easing is like, all that type of stuff. So when the shadow federal funds rate rises, um, they're already actively tightening monetary policy. And I'll pull it up in just a second. But for now, what's going on?
So here's the consensus for tomorrow. 0.25 to 0.5%. I'm just trying to read the definition here.
Yeah, 25 to 50 basis points, 96%. Yeah,
Yeah,
it looks about right.
looks about right. And then here's a something. Did you put this in here or
Yeah,
CCME group?
I put the shadow federal funds rate up there.
Okay, this is one from, let's see, CME group from Matthew Allison. Target
Oh,
rate
I think it's gonna pull up the
probabilities.
same one. Yeah.
Is that the same one? CME group? Here's this one. Shadow
That's the
federal
one I
funds
put up
rate.
there.
Yep.
So the reason why I like looking at this shadow federal funds rate is it tells you is monetary policy tightening or loosening without looking at the actual interest rates, right? So the blue line is what we're looking at. And you can see how negative we were at until roughly, I think, November of last year, we basically started to go straight up, right? And you can see that behavior in small caps, in a lot of things, right? Probability projects. Oh, that's Matthew. He's talking
Oh,
about
that's for
the,
this other one. Yeah, these tabs.
yeah, that's
Yep.
nice.
That's cool.
Yep.
I'm gonna put this on the recording, just so
There
we
you
don't,
go.
just so we don't lose it. Let's see.
Yeah, I
Allison.
mean, and so no matter what, the whole deal with federal funds rates, right, is we want to know how monetary policy is going to affect risk assets. And yeah, I mean, it's a very prominent thing. So anyone that's not familiar, I know that there's some advanced traders here, and there's some newer people. So the monetary policy that we've basically been seeing since the 80s is as the economy slows down, or as the economy overheats, or inflation becomes high, the Federal Reserve will tighten or loosen monetary policy. Basically, they'll either increase rates or decrease rates on the target rate for the nearest expiration bond yields, U.S. Treasuries. So what ends up happening is when we got down to zero in 2008, when we had the financial crisis, they had to have another way to basically drop interest rates further, but without going negative, right? Because if you go into negative interest rates, there's certain products and certain things that'll blow up in the world because we're the reserve currency. So we can't necessarily go zero. We can't go below zero on our interest rates. So we did other things. We did what's called quantitative easing, which is where we inject capital directly into the financial system. And that's basically what you see on this shadow federal funds rate, is that net effect of the amount of capital that they're injecting into financial markets pushes the effective funds rate down sub-zero, right? And you can see that on that blue line as it gets deeper and deeper. And then when it starts to rise, when it starts to go up, that's actually when that net effect is actually tightening. They're starting to tighten monetary policy, but we don't see it in the actual federal funds rate because we went sub-zero, right? So you can see right now we just crossed over the zero rate, right? And we're looking at starting to increase interest rates, but we've actually already been tightening since November. And that's why there was some defensiveness in the sleep well portfolio. That's why there is defensiveness in the passive portfolios that I run here at Aramir. But anyways, if you're basically an options trader, so how can you use this as an options trader? If you're a net short volatility trader, right? Basically, you're maybe you're someone that likes to squeeze at the money volatility or things like that. If the volatility is at the lower end of the band, it has a higher propensity to be rising, right? So Tom, if you pull up something like the VIX, if you just pull up the VIX,
Sure.
so just kind of keep in your mind there that since November, we had a big
See
spike,
here.
but actually since April, we had actually already started to see monetary policy starting to tighten, right? So where is
Here's April.
can you pull up that shadow
Oh yeah.
federal funds rate? I might have my where was the bottom
I guess,
of Yeah, where was the
Yes.
bottom in 2021? Scroll right. Yeah, where was
21
that?
right here.
June? Okay,
June.
so since June, that was basically when we bottomed out, right?
That's
And
like,
what has volatility done since then? We have not seen lower lows in volatility, right? We've seen rising amounts of volatility. And this is what happens when the federal fund or when the Federal Reserve is actively tightening monetary policy. Volatility does not like to drop. So you don't typically get lower lows in volatility, and you typically get higher highs in volatility during these time frames. And you can see this just as another reference. If you wanted to go further, we can go back to 2018. Can you pull the VIX back to 2018, Tom?
yes.
So 2018 and 2019,
Whoa.
the federal funds, we were actively tightening monetary policy. We were actually selling assets into the open market. And you can see that in 2017, we were doing okay. And then as soon as we started to tighten monetary policy, we basically had Volmageddon. And ever since then, we started to get higher lows in volatility. We never got that complacency back in. And then of course we had, COVID. So we've kind of had this super cycle of higher lows in volatility ever since then. So yeah, the more tightening, the higher volatility typically gets, and we don't get as much complacency in markets. So
Very cool. Let's see how we doing here. Just gone with the weekly, maybe a 10-minute chart. Yeah, it looks like you may have topped out short term for the day. We'll see.
do
It's
you
kind of
day trade, Tom?
interesting. A little bit, not as much as Dan. Kind of my plan is do some day trading research, but I got to get the boxcar trade alert service off the ground first, and then we had to go to Europe for Gabby's mom's funeral, so that kind of delayed everything. But the boxcar is looking pretty good. I'll probably launch it as a service next month sometime. I want to get some trades under my belt first, but it's um it's nice to be running it with Dan. Dan is he gave me all these guidelines and everything. In fact, if you want to just join the boxcar and download it, you can. But let me just put a link to the boxcar guidelines because Dan's talked about this in Trading Group One lots of times. So let me find it. Sorry. Boxcar guidelines. Where are you? Oh, here we go. And that's downloadable. So let me just paste this in the chat here. Find the chat. There we go. So those are the boxcar guidelines, and I'll be going over these with Dan on Thursday, but that's the document that Dan wrote up. And I think it might have some slight changes to it at this point, but that's basically the essence of the trade. So it's a pretty nice trade. And I'm looking forward to doing more of these. I also need to take a look at Amy's stuff and Steve Gantz's butterflies. Amy said she was up 50% for January, February. It was funny because she first told me she was up 100%, and then she's like, "Oh no, it was 100,000. It was a 50% because she started the year with a $204,000 account, and now it's 300,000. So that's some pretty impressive returns for the way Amy's trading. And I might take some of her ideas and just merge them into the boxcar a little bit. I'll talk to Dan, of course, but it's good to have different types of strategies. The boxcar is more like a weirdo iron condor type of approach to trading versus Amy's, and I think maybe Steve with the butterflies. They behave differently, of course. So um, some strengths in different markets versus other different types of trades is good to have some diversity. And like with the sleep well, put part of your capital to work in the sleep well or awake. Awake has really nice returns. It does have some drawdowns, but less than the max returns. So it's a nice addition to any portfolio. and the diversification's nice. So I guess we're coming up on an hour anyway, so maybe this is a good time to stop. We do have a roundtable tomorrow. Is it tomorrow? Pretty sure. Let me look. Today is Tuesday. Yeah, Wednesday. So we got Greg Robinson. He's got a site in the UK. They do covered calls essentially. Um, a lot on UK stocks, but also on US stocks. So it may be a little basic for people, especially in trading group one. But if you're interested, I know Tim Pearson's an animal with covered calls. I think he's got 40 or 50 positions open. But Greg Robinson, that's what they do over there. He's going to come tell us about it. And then Dan Harvey and I are going to do a roundtable on Thursday with the boxcar trade. So that should be fun. And hope to see you in either one of them or both. And then trading group one next week. And thanks for helping out, Wayne. Really appreciate it. And glad the portfolios are going well as predicted. So thanks again. And we will see everybody next time.